This
webinar,
conference will
we'll
now
be
be
covering,
recorded.
we'll be covering actually 6 topics in this webinar. All right, and these topics include market structure and technical analysis, risk management to recover taking a trade, in the trade, and the exit strategies, psychology, the effects of psychology in the forex markets and the impact that it has as well. The fundamental aspects were news effects and impacts in the forex market, and one of the key aspects as well is the homework part that deals with backtesting and journaling your trades, which will definitely and inevitably increase your growth in the forex market. Along with there's some tools, trading tools and resources that you will need that a lot of people don't know about, right? Which covers the brokerage, wallet, and market views. Alright, so we'll get into it now. So pay keen attention and empower your trading and elevate your success. Alright, so for those who are familiar with the forex market, well done. And for those who are just starting their journey, well done as well. And welcome aboard to a journey to freedom and a lot of money. Alright, so what is forex trading? Now, forex, or otherwise known as foreign exchange, it is the buy and selling of currencies across the financial global market. It is the largest financial market in the world with daily trading volume exceeding $7 trillion. That is the amount of money that is being pumped in and out the market every single day. For some people, that will be an infinite amount, but numbers don't lie. All right. Now, forex trading involves the simultaneous exchange of one currency for another, and of course, there are pairs. And an example of these pairs are like the Euro USD dollar, which is the euro versus the European dollar versus the US dollar. All right. And another example is the GBP JPY, which is the British pound versus the Japanese yen. All right. So we're going to get into the topics right away without any hesitation and see how best we can cover these topics. Like I said, anyone who has any questions at the end of each topic, please to place them. I will answer them momentarily. All right. Now, what is market structure and technical analysis? This is a study of historical price movements, patterns, and indicators on charts to forecast future price behavior. Unlike fundamental analysis, which focuses on economical data and news, technical analysis relies purely on price action and market psychology. Now, this is practically saying that the market doesn't just focus on outside aspects. It doesn't just focus on what the economy is doing or whatever thing is external thing that affects the market. This is practically telling you that the market moves with price numbers, and these numbers definitely create structure within the market. All right, that's where technical analysis comes in, where you implement your strategies and all of that. But before we get into that, we're going to go to some core principles that actually are essential to your trading success. Now, some of these core principles include one, the market discounts itself, and it discounts everything. Everything. Doesn't matter what you see, the market is doing, it discounts everything. This simply means that all current prices reflects every known factor, economic data, news, etc. So whether the market is going up or down, there is always something that is a reason behind that. The market doesn't just move and there's nothing behind it to say yes. It just moved because it wants to move. No, it's not like that. All right. Another core principle is that all prices move in trends. Like I said, the market structure is based off price, and those prices actually create structure. Now, those structure are actually formed through movements, which are actually trends. All right. Now, these are prices tend to move in trends, uptrend, downtrend, and sideways rather than randomly. So it's a sequential movement. All right. Whatever the market does, then it repeats itself. That is why it's called a pattern. All right. Another one is history repeats itself. This simply state telling you that patterns and behaviors often repeat due to consistent trader psychology, right? So whatever happened in the past, like I said before, it will repeat itself. It's just that it might not repeat itself exactly in the same time or the same time frame. All right. So that's another thing you can actually use when trading the market. Nothing in the market that is happening now has never happened before. Everything has happened before. It's just that it's at a different time now where it's repeating itself. Another one, which is one of the most popular, and it can't be shadowed at all. It is something that a lot of persons fail to understand, and it is very crucial. All right. Now, candlestick charts. This is a complete representation of movements in prices displayed in the candlestick or bar chart format. Each candle represents the current time frames and price. So if you're on the 15-minute time frame, as the example shown, it simply means that each candle represents 15 minutes. So it doesn't matter the time frame that you're on, any time frame that you're on, whether it's a daily, 4 hourly, 5 minute, 15 minute, 30 minute, 1 minute, 2 minute, 3 minute, etc. That is that candle represents that time. Alright, so the other one is trend lines and channels. Yes, the market moves in directions, which is uptrend and downtrend, because prices only move in two directions rather. Yes, sideways is one of them, but it definitely has to go up and it has to go down. Alright? This helps to identify the direction and strength of the trend or current market movements by these key factors. These key factors include in an uptrend, higher highs and higher lows, and in a downtrend, lower lows and lower highs. This can help you to identify when the market is in an uptrend and in a downtrend. Very, very essential. Right? In addition to that, you have the chart patterns as well. Nothing in the market is less than the other, so everything is as important as the other. So when you're talking about chart patterns, we know that the market moves in patterns and all of that. However, how can we identify when the market is actually going to continue in a particular pattern or going to change in to do a reversal? Alright, so these patterns are actually can you use as indicators as well. So a few examples of continuous patterns are the flags, pennants, wedges, etc. Not going to go too much in depth with it, but just giving you the idea of what it is. Reversals include one of the famous, the head and shoulders, double tops and bottoms, and the triangles, and etc. as well. All right. Uh, oh my god. Oh my god. Hold on, guys. Let me just go over to something else so you guys can see what is it. Right. So the other one is the support and resistance. Now this is something that a lot of people definitely feel in the market to identify. They might see it and they don't know what it is. They don't know how to identify it. They don't know how to utilize it. They just don't know, and it causes a lot of damage to both their psychology, to both and their capital as well. Now, support, this is where the price level buying interest is strong enough to prevent further decline. All right, always at the bottom of any and every pattern. What this simply means is that if the market is actually, in some terms, people use melting or falling or dropping, but the forex term is that when the market is in a bearish trend or in a bearish volume or selling at a particular time, it simply means that at a level below that, the strength of that drop or fall is actually dying out. It is fading out, where it cannot go any further than that. All right, and at that era, you will be getting certain indicators or certain pattern to confirm that the market is not going to go any further from there. All right, vice versa, the same thing for a resistance, which is at the top and all is at the top. We're just simply telling you that the selling interest is strong enough to prevent further incline. So practically selling pressure is now coming in to give you a reversal to go down for a sell, and the support is telling you that buying interest is now coming in to push going up. All right, we'll be moving back over to the other screen. Right. So now the next topic, which is very important, of course, is risk management. Now, a lot of people will take on their trading journey, and in an instant, they'll be making crazy profits, insane moves. They'll be on the top of the game. They just going like that and saying, "Yes, I got this. I'm doing this, and it's easy." And just one mistake can literally cause so much damage. A lot of people walk away from trading because of one mistake. And that mistake is because they don't know how to actually have a strong risk management. They might say, okay, I'm going to risk $100, I'm going to risk this, I'm going to risk that. But is it an accurate risk? Is it in alignment with your psychology and your emotions to say if you lose this amount, will it affect you externally from the market? Or will it affect your psychology? Will it affect your capital in case you get damaged? Can it be rebuilt in a particular time? A lot of people don't ask themselves these questions because they don't go through the correct principles. All right. So, what risk management is that it refers to the strategy and techniques used to protect your capital and minimize potential losses. Since forex is a highly volatile and leveraged market, effective risk management is essential to long-term survival and success as we are building a successful trading career. Why is this important? The forex market can move rapidly and unpredictably. So it doesn't matter how accurate something may be, your strategy, your technical, your how strong your psychology is, it is unpredictable. All right. Leverage magnifies both gains and losses. So you might use a high leverage and gain some big money. At the same time, it can cause you some serious losses. All right. Even winning strategies can fail without proper risk control. So a lot of times people have winning strategies, but it's not the strategy actually fails, it's themselves because they don't actually implement the correct risk that is in alignment with their strategy. And the other one is that this helps maintain emotional discipline and reduce impulsive decisions. So once you have a good risk management, it controls the level of emotions you input in the market and take from the market. All right, and you won't be too hasty to take a trade when you know that your risk management is at a certain level where if you miss a trade, you're just going to leave it alone. You're not going to just jump in it and then put a huge stop loss because you want to catch what is left of the move. Doesn't make any sense.
Yeah, true. Because a lot of people, when it comes on to risk management, they ignore the main factor that risk management is actually the key aspect of trading. Like your entire trading journey, it's all around risk management. Because you can make mistake with your technical analysis, you might get a late entry, whatever the case may be. You get what I say? Your technical can be off. Your technical don't have to be 100% accurate every time. Like nobody has that greatness in trading. You just need a slice of the pie. When it comes on to risk management, every mistake, every risk that you're taking within the market, every risk you take and you mess up that risk, you're losing money. And that brings emotional distress, fatigue, anxiety, fear of losing a trade. So everything is based off risk management, to be honest. The technical don't have to be the best, but you have to have a great system that is mainly around risk management. If you don't have that, you can just call it quits. Like it doesn't make any sense.
All right, well said. All right, so in risk management, you have some key concepts that are quite essential to this. So you must know them. It's not easy to capitalize on, but once you give it time and practice, you definitely it will be quite much impactive on your trading journey. All right. Now, the risk per trade. This is simply saying that the amount you risk must be, like I said, it must be in alignment with the amount that you're comfortable with without damaging your account. Why? Most professional traders risk no more than 1 to 2% of their trading account on a single trade. So if your account has a capital of $5,000, for example, risking 2% equal to $100 max loss per trade. Does it make sense? You over leverage the trade, you use this big loss size because you want a quick gain or a quick profit and just a small move or whatever the case may be in the market. All right. Same thing with the stop loss orders. Now, stop loss orders, this is a predefined level where a trade is automatically closed out to prevent further losses or loss. I must always set these things. All right, it's very essential. Does it make sense to take a trade with no stop loss and then some economical event, whether a news, a major impact news, or some crisis within the moment gives you a spike or some slippage happen and there's nothing to prevent a certain amount of losses. So if you risk, say you want to risk $100, why place a stop loss that is? Why not put a stop loss that is at $100? Why just leave it open like that, leaving room or the space for the market to take everything out of your account. That's just going to leave you to cry, and that's only going to tell you that you're not ready for the market at all. All right. One of the key benefits of this is that it removes emotional decision making during volatile markets. All right. Another one is the take profit orders. So these three are actually in alignment. The stop loss, the take profit order, and the risk you take per trade. Now, the take profit order close your trade at a specific profit level, helping you to lock in your gains. And yes, you must always set this as well. Because for one, the same way how the stop loss orders actually removes emotional decision making during the volatile markets, it is the same way how the take profit orders actually limit the greed that you will actually develop in the market, because it is inevitable. Everybody gets greedy at some point, but this helps you to maintain a level in the market. So if you take a trade and you're targeting a logical target of $100, right? You need to set a target of $100. Don't just look at it and say, all right, if the market goes there at 100, I'm going to close out. Because sometimes the market tend to go very close to your take profit area and turn back. But because you didn't have one to have something to view at the time to say, all right, this is good enough for me because it's had actually $98. So I'm just going to close out now. Because you didn't set one, you're just looking at it flowing with the hopes that it's going to go there. All right, so that actually helps you when you have a take profit order. And for many people who say, for instance, they're trading the night session, Tokyo or London, setting a take profit is like you're going to sleep and it's there. So in the market, once the trade goes accordingly with your technical, definitely you will wake up with profits. All right. All right.
Yeah,
All right.
so basically, when it comes down to risk management concept, as Rocky was speaking about, a lot of people tend to adjust their stop loss and their take profit. Well, it all comes down to proper risk management, proper system, and the way you go about taking trades and exiting trades. That's a part of your system. It's a part of risk management as well. A lot of people tend to see the market as they're in control. They move the market. They can say, "Oh, I hope the market go to this specific area. I hope the market can give me $200." In which it doesn't work like that, right? So, for instance, you have a take profit that is set at a logical air for $200. The take profit is almost there. You're at $190 profit. A lot of people tend to be greedy. So, oh shit, it's moving so good. It's at 190. It almost reached my 200 target area. I'm going to adjust my take profit and try to get 250 instead of waiting for price to actually hit that 200 mark, step away from the chart and come back a different day. A lot of people intend to like adjust their take profit, move it to the 250 mark, and price eventually turn back so that $190 that you were initially in with equity will turn back to $0 because you didn't follow your risk management system, you didn't follow the risk management plan, you let emotion get in the way, in which it's not gambling, it's strictly business, and the market has no feeling for anyone. So whatever you do, whatever action you take, you're just hurting yourself. Same thing with a stop loss. If you have a stop loss and you're willing to risk $100, right? you're willing to risk $100. Price is almost at that $100 loss. You're not supposed to adjust your stop loss to say, hey, probably the market is gonna go back up. That's hope. You're not trusting your technical analysis. Just like as if you win, you can step away. If you get a loss, you can come back a next day because proper risk management, you can lose three trades and win one, make back what you have lost and more. So proper risk management is the way.
Right, and I agree with that 100%. All right. So a lot of times we tend to not utilize our risk management and working based off hope, and hope kills you in the forex market. All right. And the next one is leverage management. Now, leverage allows traders to control large positions with smaller amounts of capital. So if you have a small account, you can capitalize on market orders with small gains or losses. All right. So leverage is like you maintaining balance with your account where losses and profits are concerned. So if you end up with a loss, it won't be a major loss to damage the account. However, if you end up with a gain, it won't be too much of a big gain nor too less. It'll be something that you can be satisfied with based on the amount of risk. So that is why I use the term balance. All right. So you use low leverage to reduce risk exposure, and you use the low leverage alternatively to accumulate gains, just not quick gains. All right. Common mistakes to avoid in the risk management technique. All right. Now, knowing these concepts and having them does not guarantee success without eradicating these potential habits. Why do I use the word potential? Because it is inevitable while growing in the trading industry. Alright, it's a must. You will come across these habits, these emotional effects, and how they will actually affect your trading or impact your trading. Alright, so these habits often lead to great or great regrettable mistakes, of course, because they're not good. Alright, some of these mistakes to avoid are over leveraging your account. As mentioned before, if you don't balance the amount you're going to risk versus the reward, then definitely trading is not for you. Or at least you're not ready yet. Alright? Not using a stop loss, as we have mentioned before. Risking too much on one trade, putting all your eggs in one basket. Not good. Chasing losses are actually doing revenge trading. You lost a trade and then you're eager to gain back all the money that you have lost because you did not go with your risk management strategy. No good. If you lost, you lost. Holding on to losing trades profitable for possible profits, as O'Brien has just mentioned before, you're holding on to something that you're not even sure if it's going to happen. Even though it's actually, because it's a two-way street. All right, now let me explain to you. All right, so holding on to a losing trade for possible profit is that when you learn about the patterns and how the market moves, the support and resistance, the indicators of a reversal, and all of that. If the market is going against you and it's actually in your stop loss area, and you identify these key things to say that, okay, this is a losing trade and this will not be profitable for me at all, you can cut your losses short. So instead of, for example, that I take is $100 margin, you risk $100. but you see that it's in your $75 loss already, and you have all confluence to say that the market will not go in your favor. You can just break even within the loss and cut it short. So instead of actually losing $100, you lose $75. So if you actually take it within the actual aspect of how I'm saying it, it is not saying that you should create a habit to say, all right, if the market that go against me, I'm just going to close it out. That is not what I'm saying. Because sometimes the market does do fake outs, deeper retracements, and then actually goes in your favor. What I'm saying to you is that when you identify that the trade is actually a losing trade, it will not go in your favor at all. It does not make sense to hold on to that trade. None at all. All right. And it's the same thing as to when you're in profit. You are in profit and you have set a target of $500 and you are up $450 and you see that the market is at a level that is respecting in the past, and you get enough confidence to say that okay, this market is going to go against me. Why hold on to that trade when you're up 450 and you're $50 away from 500? Why hold on to that trade for it to turn into be a minus 100 trade? That's just insanity. So a losing trade can show its potential when it's in profit, and it can actually show itself when it's actually in your stop loss area. And that is why I said it's a two-way street. All right. And another one is ignoring market conditions or news impact. Now, the market conditions that we're specifically talking about now is that persons tend to trade the market outside of the session at which the pair that they trade. Now, many people tend to trade a pair outside a session and then they're wondering why it's not going that well, why it's not going in your favor, why you can't understand it's doing this, the volume is so low, you're getting these weird spikes because you're not actually trading. The time at which you're trading that pair is not in alignment with the actual time at which it's reactive. And the new its impact refers to you're on the Forex factory, right? Which is the calendar to show the news time and the impact the news might have on the market. Now, you're on a FOMC, or for example, you're on a NFP week, and on the Friday, you see the NFP news coming up, and because you see a move that is going to happen, but you're ignoring the fact that the time at which you're going to place the trade is not in alignment with that news because we all know that NFP is a killer. Yes, it can be good, but it's a killer, right? Why would you ignore that major impact news at that time and take the trade, and then when you're in a drawdown now or you have ruined your account, blown it, damaged it, you're going to say the market is trash, the market did this against you? No, you did it to yourself because you're ignoring something very important. And that is why before I mentioned that fundamental aspects does affect the market. So you can't ignore these things.
All right. So basically, Rocky went over a lot of aspects in the risk management and avoiding common mistakes. Over leveraging, for example, a lot of people tend to risk their entire amount in like one trade. That doesn't make any sense. That's over leveraging your account. You have $100, right? Bear in mind you have a platform which is MT5 in which you place each trade that you take that is connected to your brokerage. If you're going to set a stop loss and the stop loss you're going to set shows that you're risking $100 if the market goes against you. That means you're over leveraging your account. That means you want to risk all your account in one trade, in which you're not trading for longevity. You're just trading to make a quick bag, in which that won't work. It won't be sustainable for anyone that is doing that. So it's very easy. Like if you have $100 in your account, you have a stop loss in which it says that you're risking $100 for $100, which is your balance. You can easily decrease your lot size. A lot of people tend to keep the stop loss even though they know they're risking their entire account. You can simply just decrease the lot size and think long term. Not using a stop loss, same thing that Rocky went over. You have news, you have economical events, you have fundamental events that the market can move in a split second. Drop 500 points, negative 500 points in a split second. That's your entire account. That's why you use a stop loss to help protect your balance. Risking too much on one trade is the same thing as over leveraging your account. Chasing loses, revenge trading. Rocky went over that. And the same thing that I said prior, holding on to losing trades. Doesn't make any sense. You can walk away from the market and go again. Like as I said, you can lose three trade, win one, and everything is it's there. You get what I say? You don't need for a fight or revenge trade because as I said, the market has no remorse. Uh ignoring market condition or news impact. Yeah, you need you have platform like investment.com, FOMC, major impact news, CPI. So you utilize those platforms to tell when there is a news coming so you can prepare for it. With my trading system that I use, I normally trade after the news because at the end of the day you can have good technical analysis, but fundamental is like a quick proco. Like it's a news that come fast and just leave. So you can have a good technical analysis. Everything adds up a high probability trade, and then it doesn't go in your favor. It spikes you out. Then like 2 hours prior to that news, it goes up or vice versa. It can, you have a sell, you set it up, it spike to the upside, then it actually go in your favor. You get what I'm saying? So always try to trade after the news pass, even 30 minutes or 45 minutes after the news when volatility and volume, everything spreads cool down. So a lot of people can utilize that and add it to your trading system because at the end of the day, it's not gambling. It's all about probabilistic ideology. It's all about probability. You're not guessing. You're not predicting. It's like high probability the market will go up, high probability the market will go down. So at the end of the day, nothing is sure. You're just using your knowledge, utilizing your knowledge, technical analysis, your risk management, your system. You live by the system and you just trade. That's it. There is nothing about oh the market will go down, oh the market will go up. Nothing like that. You're just using your edge, which is your system and risk management, and you just trade like that all the time, 100%.
Well said. Thank you for that. Now we're going to go into our next topic as you have just covered this one. And this topic now is the most important one of them all, psychology in forex trading. Now, a lot of people will be like, all right, we're looking at patterns, we're looking at charts, we're looking at numbers, we're looking at this, we're just using tools and all of that. How is psychology the most important when you're dealing with money? Exactly my point. You're dealing with money. So you need to understand how this mentally and emotionally affects you and how it can impact on your trading career. Now, this is the mental and emotional factors that influence decision making in forex trading. Mastering your psychology is often more important than technical skills because even a great strategy, as mentioned before, fails if you can't manage fear, greed, or stress. And one of the famous quotes by the great Alexander Elder: the goal of a successful trader is to make the best trades, money is secondary. And to make the best trades, you have to have a very solid psychology in the market. Because once your psychology is thrown off, you it doesn't make sense to even trade for that day. total destruction, because all your emotions will not be under control, and they'll be just having a playground in your mind, in your heart, in your fingers, in your eyes. You won't see exactly what you need to see until after the damage is done. All right. Now, psychological factors that impact traders are fear, causes hesitation or premature exit from trades; greed leads to overtrading or risking too much to make more; revenge trading, that a lot of people do; emotional reaction to a loss, trying to win it back; and hope, as I mentioned to you guys before, hope that the market kills. Hope and denial, holding on to losing trades, hoping the market will turn. You trade what you see, not what you think. At the moment you start to think, that is when you start to invite hope in the market. All right. And by the great Mark Douglas, from the famous author from Trading the Zone, he specifically stated that in his book that it's not the market that beats them, it's themselves. I said it in a different way earlier on in the webinar. All right. So if you can't control your own emotions, your own psychology, then how can you control your own capital? How can you control the amount that you lose? How can you control the amount that you even win? So it is very crucial. All right. How to develop a strong mindset in trading. Since psychology is so important and it is crucial and all of that, how can we actually develop a strong mindset then towards that? Now, we can do this by sticking to a trading plan, which is one. A trading plan consists of defined rules used for your entry, exit, the amount you risk, and the strategy used. So once you have a trading plan, refine it by practicing it and stick to it once it's working. And one of our quotes from our trading system that we will provide to you guys says that a trading system that works never hurts. So once you create a strategy that is working, it even when you gain a loss, you can say that all right, so the knowledge is correct, it's just that I made this slight error because of this. Then you know that your strategy is in alignment with what you're doing. It's just that within that time, some external thing, like I said, fundamentally might change the outcome of that. That is why practice becomes perfect. The another one is using your journal. This is recording your trades, controlling your emotions, and your decisions. Alright, so when you record what happened in the trade, why you take the trade, when you take the trade, how did you take the trade, how long did you stay in the trade, what did you see, then that helps build not just your psychology, but they also build an actual column for you in the market. So it's like you're creating something unbreakable in the market because you're going in firm, stronger each and every time because you know what you're doing. All right. Accepting your losses as normal. No strategy wins 100% of the time. We keep on repeating this over and over and over because we do not want to give you guys the idea to think that going in the market is just a winning streak. It is not like that. So even if you get the perfect strategy in the market is not your friend. It is unpredictable. So something definitely can go against that. The important thing is that you have the knowledge for the market. Once you have the knowledge, the money will come. All right. Use risk management always. When you know your maximum risk is control, you reduce anxiety. So the example that I mentioned before, that you need to balance off the amount that you're going to risk so that it's in alignment with your capital. That's what controlling the maximum risk is about. So if you gain two losses for the day and you see that, all right, I have reached a certain amount that I do not want it to cross for this time, you just step out the market. You control yourself, you control the risk, and you step out. Because tomorrow, going in, doing your journaling, refining your strategy, and accepting the loss of yesterday. So for tomorrow, definitely going into the market, who to tell you might be even more profitable than yesterday. All right, so that's what controlling the maximum risk is about. Not just trading, trying to get back the amount that you lost just now. That doesn't make any sense. Same thing as avoiding over trading. Trade less, but with higher probability setups, because everything in the market is based off probability. All right, so when you learn how the market works and you have mastered your strategy and you know what you're doing in the market, you won't be taking 4, 5, 6, 7 trades for the day. Maybe you'll be taking one trade for the day, or maybe three trades for the entire week, and that would be magnificent for you because you have now conquered not the market, but you have conquered your strategy, you have conquered your psychology, you have conquered your risk management technique that you're using in the market, and that would make you separate you from the rookies and put you up there with the professionals. So avoiding overtrading is very much important. You need to relax sometime. All right. So O'Brien, you have anything to add in addition to that before we go on to the next topic?
Now and proceed on.
All right, awesome. All right. So as we have mentioned a couple times during the webinar, that fundamentals do affect the forex market. Now, what are fundamentals in the forex market actually, outside of just economic things and news and all of that? All right, this involves studying economic, political, and financial factors that influences the value of currencies. Unlike technical analysis, which focuses on price charts and patterns, fundamentals looks at the why behind market moves. In other words, causes of price spikes at a particular time. Like I mentioned before when I was talking about the NFP week on that Friday, the NFP, why did the market do a big spike like that? The non-farm payroll. We know that happens every first Friday of every month. That's a high volatile news, right? And that is the exact why behind the market did that spike. Likewise, FOMC, if it's a major impact, or a CPI, or the famous Powell. When Powell speaks, we all know the damage that Powell is speaking about. Problem take place, right? So that's what it's actually saying. All right, so key elements of fundamental analysis. Like I mentioned before, giving some examples. Interest rates, inflation rates, economic growth, employment data, geopolitical events, and trade balances. These are just a few elements that actually has a direct interaction with the forex market. Now combining fundamentals with technicals. And yes, this is where things get tricky. This is where deep understanding comes in with your technical and understanding the fundamentals of it. How you can actually make them come in correlation with your trading strategy. How you can actually put them together to make it work to build that successful trading career that you want. All right. Now, many traders uses a hybrid approach, which includes the use of fundamentals to identify big picture trends. So for like the position traders will be trading for like weeks and months. That is far outside of we as retail traders. All right, they will be trading bigger trends, looking at the daily candles and all of that for longer positions than we are. All right, and also the use is technical to find precise entry and exit positions. All right, so with that being said about precise entry and exit points, this simply means that if you're in a trade in the session, it's going well, it's doing really good, and within that time, it is 50% in your take profit, and within that time, a major impact news is coming up, you can break even at that time with a clean exit strategy, knowing that all right, within that moment, I should be good. All right, so that's just one example you can use onto that. All right. O'Brien, you want to elaborate on that one so they can get better understanding?
Yeah, and for emphasis, like when it comes down to hearing fundamental and hearing about news, like employment rates, whatever is affecting the economy. At the end of the day, you have to differentiate. Like you have technical traders and you have fundamental traders. You have people that actually wait on a major impact news to actually trade the market. So whenever you go online, you search YouTube, whatever the case may be, you're gonna always have a debate between technical traders and fundamental traders. But at the end of the day, technical traders is always going to be on top because you're using past data, you're using support and resistance, you're using actual market data to give you a high, like a high win rate or a high probability trade. Like you're gathering information, like I would say, you're gathering your hypothesis to make a decision. So when you're talking about fundamentals, if there's a big news coming, and you say, all right, based on the information that I gathered, something gonna happen bad in the market, so I'm gonna sell the market, in which you're guessing. And that's where issues come in when you're a trader, like you're trading by yourself, you're using your own knowledge. It's always good to work with technical instead of fundamental because 65% of the time, a high impact news is like announced. There's a high impact news. This is a high impact news. It's gonna affect the market, and bam, you didn't take a trade. You had your technical setup. The technical went in your favor. You didn't take an entry because you're saying that there's a high impact news coming. When the news did came, but it didn't have any effect within the market. Hence the reason a lot of traders trade fundamental, waited for news and nothing happened. But whenever you're using your technical to guide you, it's always gonna be an opportunity. So don't get it twisted like, oh, fundamental this, fundamental that. You can mix fundamental with technical for volume wise. Like if the market is moving slow and a news comes, sometime it will give the market that extra push, but it's always going to go with your technical analysis. Just for emphasis, those you can notate that.
Yeah, boy. All right, so well said, and I hope everyone actually got that. You know, and guys, please remember, don't be afraid to ask question in the chat. All right, don't be afraid. All right, now important fundamental reports or news, and some of these examples are indicators that impact the forex market, which are the NFP, as mentioned before, the non-farm payrolls, which is the US job creation data. Oftentimes, well, practically in my experience, all the time, NFP is highly volatile. This is a very impact news. So, yes, FOMC meetings, which is the US Federal Reserve interest rate decisions. It all depends on the news that is coming out at the time. Because sometimes FOMC comes out, but it's not exactly a major impact news within that time. Alright? So it all depends. The CPI or the PPI news, which are inflation indicators, those often come out as major impact news as well. But like I said, it all depends on the time at which it's coming out. Retail sales, which is the consumer spending strength, GDP reports, economic growth, and central bank speeches, policy guidance. All right. Now, ending fundamentals. I hope everyone understood what fundamentals are about, how it affects the forex market, how it can impact your trading, and how you can actually capitalize in both timing and exiting a trade, taking a trade, when not to take a trade, and stuff like that. All right, how to identify when the market is actually volatile within a market. Like for example, you just wake up or you just got on the charts and the market is going wild, and you're wondering like, wait, what concert is keeping? Actually, it's just something happening fundamentally. You just need to check on it. And O'Brien give a few examples, which we'll give you at the end of certain platforms you can use to check. You just need to check to see what's going on. All right, don't be hasty to just take a trade because you see that price is actually moving fast at the time. Orders has already been played. It's just that orders are just now being auctioned. That's all. All right. So the last but not least of the topics that we're going to cover is the homework, backtesting, and journaling. Now, this is more of a character building aspect where forex trading is concerned. And with that, it then covers everything else because everything falls under that category. Because whatever notes you put, you're going to add in your psychology, you're going to add in your risk management, you're going to add in your technical analysis, you're going to add in your fundamentals, you're going to add in every single thing just to go into that. All right. So what I'm going to do now, being that we're going to go through this, I'm going to give everyone a chance to speak at their desire as we go along the ending of the webinar. All right. So momentarily, everyone can then ask verbal questions and you know place any pointers they feel. Not no answer is a wrong answer. No comment is a bad comment. Which that is within trading, of course. And this is a community. We accept everyone and we treat everyone as equal here. All right. All right. So what is backtesting? All right. So first, you're going to cover each one of them step by step. All right. So doing your homework in forex trading means consistently preparing, analyzing, reviewing your trades, strategies, and market conditions. It is what separates serious traders from gamblers. So whether you're a beginner or experienced trader, doing your forex homework builds discipline, improves decision making, and increase your chances of long-term success. All right. Can you trade offline first before going live? Trading offline, no. What you can do is actually you can practice offline on the trading view using the setback. It's on. We're going to give it to you, but definitely you can't trade offline, but you can actually practice offline using that, where you
Um,
can actually real
uh,
time in that time.
yeah. For the question, like back testing, or I can just go over that. When him asks, can I trade offline first before going live? You can paper trade, and you also can trade a demo account to sharpen your skills. Won't demo trading won't be the same as live trading because it's not real money. But pertaining to the question that you're asking, practicing technical analysis, journalizing technical analysis is different from actually, like, if your question is about trading online, you can trade a demo account, but like trading a demo account won't be the same as trading a live account because you're not dealing with real money, no real emotions. So you can make 200,000 off a demo account and can't make $10 off a real account. So that's the reality, right? Because there's no emotion. It's not real money. You're not losing anything. So if that's the question you're asking, yes, you can practice by demo trading.
Right. So with that being said, that is why I gave you the answer, because I want everyone to understand that trading live with real money, that's the talk. That's where character is built. That's where mindset is built. That's where your strategy becomes better. That's where your risk management becomes sharper. Your technical analysis becomes on point. That is where the talk actually is, as said before. All right. I don't want you guys. Yes, you can do paper trading, but I don't want you guys to get um hooked on to trading a demo, because you won't get the actual feeling, the actual impact and the effects of it. Because if you lose $10,000 on a trade a demo account, you can just own my next demo account. But in real life, you can't do that, because the market is infinite, but your capital is not. All right. So I just want you guys to just keep that in mind. So you can practice on a demo, but bear in mind that live trading, that is where actual building a successful trading career is concerned. All right. So great question, and keep them coming. All right. So what to do when doing your homework? Well, you need to do your daily market analysis. All right. So on each day that you place a trade, you don't need to do it exactly every single day, because you won't be trading every single day, of course. All right. Whether by external issues like personal things and all of that. All right. So on the days that you actually trade, ensure that you do your market analysis. You record those things as before. Review your trading plan always. See if cause your trading plan might work for 2 trades and it might not work for the next 3. Why did not work for the next 3? Well, something is missing or something wrong. All right, so you need to always review your trading plan, even if you have a 5 win and a 1 loss. Please to review your trading plan on that loss. Identifying your mistake is very crucial, and alongside that, taking accountability for that mistake is what makes you a profitable trader. You must accept, say, regardless of what happened, you are the one who made that mistake. Once you can accept that, you're good to go. All right. Back testing and strategy review, which we'll go into. Journaling past trades, of course, the ones that you did before. very important, and learning and skill development. All right, so once you do your homework, inevitably you're going to see things that you did not see before, and you're going to identify things that you totally skipped past. And then that's where the mental skill is coming in and the visual skill is coming in. So definitely you will be start growing from there, just like a flower from a bad soil, because you're now putting in the extra work. All right. Will forex teach a person interested in becoming a trader? Of course, of course it will. Once given the right teaching and guidance, courses, and mentorships upon your desire, it will definitely guide you in becoming a professional trader. However, I can teach you for 5 years straight. However, it is you as that trader who has to put in that extra work on his or her personal trading career to become a professional or profitable trader that is. So it doesn't matter how much knowledge someone gives to you, if you don't take that time, that extra time and sacrifice to put into your trading plan, your strategy, you yourself as a upcoming trader, you can never be successful. You will make money, but will you become, or will you actually bring out that full potential within yourself? I highly doubt it. I've never heard of it before. I've never seen it. And no media and no real time scenarios. Alright? Now, back testing to answer the question above. What is back testing? This is the process of testing a trading strategy using historical price data to see how it would have performed in the past. It helps traders evaluate the effectiveness, profitability, and reliability of their strategies before risking real money. So that's what backtesting is about. So even if you didn't trade on that specific day, you can backtest the market movements of that day to see if you were in the market at that time. Would you have capitalized? Would your trading strategy be in alignment with what you would have capitalized on? Would your trading plan be suitable for that market movement in the day? Would the risk of taking that trade would be in alignment with your capital? That's what it's practically saying to you. So back testing is very, very important. How do you backtest new strategies without falling into confirmation bias?
So how do you backtest new strategies without falling into confirmation bias? So basically, bro, it's not about like you basically say new strategies, as in more than one. Trading is like a lot of people when you're interested in something, you tend to go on social media, go on YouTube, in which a lot of people talk about different things for views. You don't need to test a million different strategies. You have different types of trader. You have scalpers, intraday trader, position trader. Every system or every type of trader comes with their own personal belief. So if you're working right and you get off work 6 p.m. Eastern Standard Time or whatever the case may be, that means you reaching in time for Asian and Tokyo session and also London session, and during New York session you're busy, you're at work, for example, right? So if you're going to be a trader, you have to align that type of strategy with your personal life. So if you have time to can trade only London session, you have to build. a strategy based on your timing, your personality, and everything that comes with that. So you don't have to go online. You would have to do your own back testing. If you have a good mentor that can help you build a system that can define or retain to your personal living, that's what you have to do. So you can't build like a million different strategies. You only can build a system or a strategy that works for you, your timing. So a lot of people will say, oh, I missed out on that trade because we need the work. Well, you're gonna keep missing out trade because you work every day, right? To build a system or a strategy that works for you. Everybody different. Other people don't like to sit around a screen for probably 2 hours or an hour. That means nothing is wrong with that. Become a scalper. So you learn a strategy how to be a scalper. You still have to read books if you don't have a mentor. You don't have to force to say, hey, I'm going to get a mentor. You can get books, you can read books, you can go on the market, use past data and create your own strategy. Or if you can get help from somebody that has success or is consistent within the market. You get what I'm saying? So building a strategy is all based off your personal aspect or your everyday life, right? So that's how the main thing about it. You're not a million strategy or whatever the case may be. You just need to build something that can retain your lifestyle, your emotions, your personality. A lot of people impatient, a lot of people patient. So if you're impatient, your reality is you're not change your impatient is over 2 day or a night. You like move faster, try retain scalping and master scalping, right? You can't follow a next person or build a strategy based off a next person. You see a man online from a day trade. In those I feel personality that you're a different person. You have to build your strategy and your aspect of trading based off of how you live and how you stay. Your inner self. Basically that.
Well said. All right. Can I have more than one account while trading different currencies? Because I see a lot of traders with these big screens and monitors. What's the reason? Because I have one device. No. All right. So pertaining to that question, yes, you can have more than one account. All right, while trading different currencies. It's just that you need to understand that if you're trading a certain amount of pairs that are in a particular session, or you like a certain pair, but other pairs that you trade with it as well are reactive in that same session, then you don't necessarily need more than one account. All right, whatever you see on the media is just like what Oriana said. You don't really watch the media like that. All right, those are just flashy things because they have it to do what they want to do. All right, so inevitably, of course, when you become a profitable trader, of course you will have this big old screen because you have the money to do it. So you want to have that comfort because the more you grow, the more you elevate, is the more your environment around you will actually have to be in alignment with your lifestyle. So you don't watch what is on the media. All right. So the answer is yes, you can have more than one trading account. It's just that if you're trading a certain amount of pairs that are within the same session, just flow with it. All right. Also, if you're trading the indices market and you're trading the volatility market, then you can have two separate accounts because, of course, not every not every broker actually deals with volatility because volatility is a derivative market that is based on derive.com, the derive entity. All right, so that's what I'm actually saying to you. All right, so the importance of backtesting. The importance of backtesting is that it validates a strategy before live trading. It reveals the win and loss ratio, the risk versus reward, and the performance metrics. All right, it builds confidence in your approach and it helps identify flaws in fine-tune rules. All right, that's what backtesting is. Now, when backtesting, how do you backtest? Based on the question on what it is, now how do you do it? You do it by defining your trading strategy. All right, you select a currency pair and time frame to back this on. You can just randomly just jump up and do that. If you're comfortable with trading gold, you back this on gold. If it's US 30, you back this on US 30. If it's NAS 100, you back this on NAS 100. If you're on the volatility market and it's 25, V25, or V75 1S, or V50, you back this only on that pair at that time. You don't jump up and just, alright, my back is this, my back is that. No. You select the pair that you're comfortable with, that your strategy is in alignment with, your trading plan is in alignment with, and you back this that pair along with the time frame as well. Right? You gather historical data like the amount of pips it move within a particular time, certain reactive areas, and all of that. Right? Manually or automatically run the backtest, right? And analyze the results. So even though the results might come out good for you, profitable result, it is always important for you to still look at the Q&A of it. Why did I take this trade? How did this trade become profitable even though I took it at this point? Because sometimes a profitable trade creates a bad habit, because you might take a trade but it's not in alignment with your strategy nor your trading plan nor your risk management, but it's an habit that you're creating now, that it become beneficial within that time, but over time continues to do it is going to damage your account. I say it's always important to analyze the results regardless of the profit that you end up with at the end. Alright, now journaling your trades means keeping a detailed record of your trades, decisions, thoughts, and emotions. It's one of the most powerful habits that separates disciplined successful traders from inconsistent ones. Now, what to do? You need to track the performance and progress, identify the strengths and weakness, spot recurring mistakes, improve emotional control, refine your trading strategy. How to generalize your trades? You need to record basic trading information, recording date and time, currency pair, direction with a buy or sell, entry and exit price, lot size used, stop loss and take profit, and the results in pips and monetary value. Identify the trade setup, the reason, indicators or patterns, time frame, and you can screenshot the chart at the entry of the time whenever you're doing a journaling. So you can go back and say, all right, this is what I did at the time. Why the risk and money management? The risk you took per trade in percentage, the amount that you risk, the risk versus the reward, the amount that you risk versus the amount that you want to gain, and the position sizing. Alright, so, all right, and the other one is the other one. The other one is the emotions and mindset. What are you feeling before, during, and after the trade? Whether you're anxious, you're overconfident, you were revengeful, you were hesitant, you were experiencing FOMO at the time. So you need to definitely jot down these things. All right. So moving on, the outcome and reflection, the Q and the A that you must ask yourself all the time. Was this a good trade regardless of results? What did you learn from this trade? What will you do differently next time? The goal is to constantly improve your knowledge and adapt to changing markets. So the trading tools is very short. The trading tools and resources that you're going to need. Now, to trade Forex successfully, you need more than just a broker account, a combination of analysis tools, platforms, data sources, and educational resources can greatly improve your performance and decision making. Here's a breakdown of the useful tools and resources in the Forex trading industry. Alright. Tools and resources include trading platforms. These are where you execute trades, run analysis, and manage your accounts. At the MT5 or MT4, the trading view is a web-based platform great for charting and social analysis, ideal for multi-market traders, forex, stocks, crypto, etc. Charting and technical analysis. Once again, trading view is very good. Clean chart, customizable indicators, and it grants community ideas. Alright. MetaTrader indicators, the RSI, the MACD, moving averages, and Fibonacci tools. Another is economic calendars, I mentioned before, helps you to avoid volatile events or plan news-based trades. First trading factory calendar, which is very effective, my FX book economic calendar, and there are others. News and fundamental analysis sources, the Forex Live, which is real-time news and commentary, daily FX forecasts, reports, and educational articles. It's optional, it's not necessarily a must. And the last but not least is the education and books, because of course knowledge are in books. Because a lot of people don't know that, because a lot of people don't like to read. All right. Uh, the education, definitely you can get the education from our highlighted and owned academies, which is Forex Wolf Academy, and yes, the Lionheart Forex Academy. Now the books available, one of the best one, which a very good rating, which was reviewed by a big professional trader. Mastering Forex Trading by O'Brien Patterson himself. And the other that is going to be released very soon, The Trader's Regret, Common Mistakes and How to Sidestep Them by O'Brien Patterson. We also have trading journals. My FX book is a very good one to use. It's automated linking with your broker account. So you can link it with your account and it can record what you have done, and then you go on it and you can manually just input the necessaries. Backtesting and simulating tools, trading views, the bar replay. Like I said, if you're not on the market at that time and you want to backtest on that day to see what is going on, you can just go on the bar replay on the trading view, and it is very good. It is sharp and accurate. Playback price action for practice, and the calculators and the risk tools include the pip calculator. You can go on the web and type it in, and the position size calculator also available on the web. All right, so that is the end of the topics covered in the webinar, and I hope everyone understood what was being said, and whatever questions you can now proceed in asking them, and we'll momentarily answer them one after the other. All right. Now, what do we actually offer as two mentors, two column created in Jamaica? Right? What do we offer? So we offer mentorship and courses. We offer some very sharp signal groups. and trading books as well. The more you learn, the more you grow. All right, I said that before, and it is a very accurate. You can just use that as a motto on a daily basis. All right. The moment you stop to learn is the moment you stop to grow. All right. Okay, so the mentorship and courses brought to you by Forex Academy and the Lionheart Forex Academy. We don't just teach Forex trading, we build confident, disciplined, and consistently profitable traders. Whether you're a complete beginner or looking to refine advanced strategies, our academies deliver real world education, practical tools, and hands on guidance designed for today's fast moving markets. All right. Now, at this time, a promotion is going on right now in Lionel First Academy where he's actually doing some courses that will be given free only for a limited amount of time. So please do DM in at the end of the webinar to get the necessary information. All right, and for Sulf Academy, are actually having a discount promotion at this time. All right, so whichever one you guys feel more comfortable with, you can definitely DM us at the end, and we will put you on the necessary programs. The signal groups. Now, the indices sniper signal group and the VIX sniper signal group, these are two successful trading groups since 2024. We actually created this group over a year now. We have just passed our anniversary in May, and we're actually moving forward into 24 months. So it's very good and very helpful. We provide high quality real-time forex signals backed by expert analysis, risk management, and consistent results. We're more than just a signal group, we're a trading community built on trust, transparency, and performance. So we don't just send out signal groups and that's it. We actually communicate in the group and we discuss certain things. We share the trade and all of this, and we become a family within the group itself. All right, the trading books. These are the cover for the trading books: Mastering Forex Trading and the Trader's Regret. Okay, these books aren't just another series of trading books. They are a complete roadmap for developing the mindset, strategy, and discipline required to thrive in today's financial markets. The book that is available right now, which is Mastering Forex Trading, is available on Amazon and the ebook as well. These books deliver real world guides built on proven principles, not hype. As I mentioned before, these books, one has been reviewed and the other is now under review by experts who has been there, done that before us. All right, and that is it for building a successful trading career on tonight's webinar. Wow. So thank you everyone for attending our Forex Trading webinar. We truly appreciate your time and participants. We hope you find this session informative, engaging, and valuable for your trading journey. Whether you're just starting out or looking to sharpen your skills, we're glad to be a part of your growth in the world of Forex. So really appreciate you guys for joining, and it has been something to remember. This has been yes, I like it. I like it, and I really enjoy the fact that you guys are actually communicating with us. You're not being shy. You're actually, you know, voicing your questions, and that's a very good way to actually make the first step into forex trading. So thank you very much. Like I said, you guys can. We will be providing or sending another email to the to each and everyone in regarding courses, signal groups, and all of that. So definitely everyone receiving emails pertaining to that. along with our contact information where you guys can contact us to form meetings, join the courses, join the signals, get the books, and yeah, begin your journey. So that's what it is. That's what it's about. So let's get into it. I hope everyone take this as not just a webinar or informative session. I hope everyone actually take this seriously as something to actually take into the future with them, use it as a pillar to find themselves on top of the mountain. So thank you guys once more and really appreciate it. Uh O'Brien, if you have anything to say you can now proceed.
Yeah. It was great, very informative. Always good giving back to the community, sharing knowledge, sharing real time experience. As I said prior, you can send your emails. We'll be sending out a course, free course, actually, to sharpen up your knowledge. It's all about helping other traders. It's not rocket science, but it's not easy at the same time. It takes dedication, commitment, and also work ethic, right? But there's a lot of money for sharing, like sharing your knowledge, sharing your expertise. Because when I just started, like a lot of people was like, oh, 25,000 USD for course. This was back in COVID, like 2020. And I did my research, I did my due diligence, I bought books, I did whatever I needed to do to reach where I am today. So sharing is always good. Giving as much as you can. It's not everything is about selling or whatever the case may be. If you can help a few people, go ahead and do it. Like the free course, probably give away a free system. Just shoot the emails. We'll see what happens. But very grateful to have everyone participate, taking in the knowledge and growing. So yeah, cheers.